Very good evening to all of you. This is a future trend series with Sunil and me. Sunil has been a regular feature. I have been very irregular, I must admit. There are a lot of things that we are grappling with and which is not sparing me enough time to come in front of you. I will make a genuine effort to be in front of you as much as I can, possibly in the future. But having said that, if you've some of you, if you've seen the Instagram or the post that we had put together to invite you for this particular webinar, there are certain pertinent questions that are there in my mind and in investors' mind. And we want answers of that, as Sunil has promised today, with all the data, with backing our presumptions out there and what we expect the markets to look like moving forward. Markets have had a decent run, and when the markets have a decent run, we always go and challenge that how far this run would last. The latest numbers that we look at make a presumptive story, and that story that today which is coming out is with a lot of experts and with a lot of things that you read and you listen to, that India is trading at a higher valuation. We also talk about India being trading at one of the highest valuations, rather the highest valuations within the emerging markets, and emerging markets anyways is trading at a higher valuation than various other markets. So whether we will be able to sustain this particular valuation is the first question. I think the base assumption itself that whether we are trading at higher valuation is also something that we got to challenge today in our presentation and the numbers. And then obviously the question arises whether if we are trading at a higher valuation, then whether we'll be able to sustain that. The second is the big piece that I think Sunil has pointed out, and we had pointed out during the launch of the Mojo PMS as well, as one of the factors is the ROE expansion and how fast we see this particular ROE expansion to happen. And because, you know, a higher ROE means that the country can take a higher valuation. So it is a base recipe to justify valuations, whether if we can have an expansion of ROE as well, then whether the kind of just valuations that we are talking about is something that can be justified. The third obviously is, you know, what's happening in Israel, and whether there are factors that we see that can impact the markets in a shorter run, in a longer run basis. And my fourth question would be that how the returns over the next 1 year period would look like, and how within that returns, whether large cap, mid cap or small cap, where exactly is the opportunity. So with these 4-5 points, today we are going to dissect all of that as Sunil has promised, and we look at all of that data, and then we'll open up the forum for Q&A. On to you, Sunil.
Thanks a lot, Mohit. So 4 questions, very pointed one, and let me answer each one. But before I begin my presentation, my favorite slide, disclaimer. Please note that this webinar is only to enhance your understanding about the equity market or the economy or the sector. There is no way a clear-cut recommendation from our side in this webinar, either from Mohit or from myself. Please consult your financial advisor before buying or selling any stock that we discuss in this webinar. Please remember that whenever you invest in the equity market, returns are subject to market risk, and you should be very cognizant of that fact. And past performance is no indicator of a future returns. Now, that one question that keeps bothering not only to the retail investors, to Mohit or to other PMS customers, is Indian market valuation expensive? If you remember, I think last week or one before last, we did discuss about that mid and small cap valuations. I think last month, same time, when there was a crack of near about 4% in small cap in a single day, there was a fear, and I came in front of you suggesting that clearly that valuations still are not in a bubble zone that we should be all worried about. But that was a mid and small cap. So let's look at India, and that is a Nifty 50. Now, since this is a trend analysis, we always look at what has been the trend historically, and then based on that, where do we stand in terms of Indian valuation. If you look at this Nifty 50, these are the 5 trends I'm going to discuss. So let me first move to the first one right now. Is a Nifty 50 PE and ROE that suggested upside potential, and it's all based on the data. What do you look at it? If you look at this chart, the 10 years average of 12 months forward Nifty PE, because market always discounts future. We don't have to, you can't drive the vehicle in the rear view mirror, am I right? You would always look at how is the market looking like in terms of the earnings growth. And if you look at the Nifty 50 12-month forward P, we are still lower than 10 years average. It is 20.1 is a 10-year average and we are at 18.6. So no way Indian equity market is in a bubble zone. And while the perception is that Indian market did extremely well, India is not among the best performing market in 2023. And that data also I presented in front of you maybe 7 days or 1 week or 2 weeks before. We are not at all in a bubble zone. So that fear that comes into mind, India's market has done so well. See, I think the reason we have a feeling that Indian equity market did extremely well, because we recently crossed 20,000 Nifty 50, which is an all-time high, and that just gives us some kind of a 2022 we have gone nowhere. Am I right? In fact, the market was in a very, very narrow range and mid and small cap underperformed very significantly. In 2023, yes, we have gone up. Have we gone so fast, so quick that we have formed a bubble? The answer is clearly no. On the contrary, still there's a lot of leg room for a market to go up. Now, Mohit did mention about the ROE, and if you remember, the one philosophy that we strongly believe at MarketsMojo and Mojo PMS is that higher the ROE, higher the valuation of India. Now, I would not have been happy even with 18.6, with 20.1, because P is also a function of what kind of ROE India is going to command going forward. And I'm happy to inform you that if you look at this ROE chart, India would have the highest ever ROE in last 10 to 15 years. And if that is so, and normally the higher the ROE, we should logically command higher price to earning and not a vice versa. So we are not only below 10 years average, but even ROE is higher than the 10-year average. In other words, it's all the more reason that 20.1 that we saw 10-year average logically should be 22 or 23 instead of 18.1. So there is a huge scope that Indian equity market, even from this level, to give capital appreciation. I'm not talking about 1 week, 1 month and 3 months, but the moment you expand your time horizon, and Mohit was asking about 1 year, just assume that is 18 becomes, that 18.6 becomes 22, and then again market will start discounting 1 year down the line, the 12 months forward, we are almost looking at now 20-25% return in next 12 months or so. Simple mathematical formula I'm applying. I'm not applying any rocket science here. And that's the kind of valuation. Are we in a bubble zone? The answer is no. Are we expensive? Answer is no. Are we trading below the 10-year average? Answer is yes. In other words, do not expect. And in fact, sometimes we say a US market has cracked, Indian market should also. What does this logic? I don't understand that logic. If you look at US market last 2 years, they're still below than what they were last 2 years. Indian market is at all-time high. So where is that correlation between Indian market and the Indian equity market? Because logically, even US market should have been at all-time high, but still below what they were 2 years back, isn't it? So I think you should not, your investment decision, you can do trading decision, that's a different story. The trend clearly suggests that Indian equity market is not at all expensive, not at all in bubble zone, and we are much below what logically we should be commanding. So there is a huge scope for capital appreciation from this level in the Indian equity market. Now question comes, everything is a function of, the whole world has become relative. There is a very famous advertisement that I distinctly recollect, and Hindustan Unilever made a lot of money. कि उसकी शर्ट मेरी शर्ट से सफ़ेद कैसे? The same way, Where do we stand in India in terms of return on equity? Is India the only country whose ROE is going to expand, or there are other countries also going to expand? And if that is so, then what is the thing? Because if people will compare, isn't it? So what we have done, look at some data here. Most of the countries are going to see decline in their ROE, whether it's a US, which is 19.4, is going to become 18.1. Brazil coming down from 25.6 to 15.1. If you look at Russia, 18.8 to 14.4, and Indonesia, Taiwan, Japan, Korea. Only 3 leading countries are going to see the expansion in their ROE. One is India, moving up from 14.8 to 15.6, UK 13 to 15.2, and China 9.9 to 11. Now, if you look at it, India would be the second highest ROE after US amongst all leading countries. Why? Because US still, despite falling from 19.84 to 18.1, is still higher than 15.6 India would have it. But otherwise, Brazil will come below India. You look at Indonesia, 12.6. UK, even though it's going to expand, it still will be below India. In other words, India in absolute terms looks extremely good. Even in relative terms it's good. And market normally gives premium or willing to put in those countries where there is a growth in earnings and there is a growth in ROE. This is the first time India Inc. have not leveraged that balance sheet. On the contrary, they are basically doing a lot of unlocking value to deleverage their balance sheet. And in other words, the danger that we ran into in 2008, where a lot of balance sheet were leveraged, a lot of people, companies basically went outside India also to buy assets, whether it's what's Novelis from Hindalco, Mahindra went out and bought, Tata bought 2 companies, JLR and Tata Chorus, and so on and so forth. That kind of, it's not there. And I think a lot of respect will come from the investors to India. In India, IMF has revised the outlook. Very recently, I was asked by BTTV about the CLSA. All these years, they were saying India will underperform. Suddenly, on one fine day, they are saying now India will be outperforming. And more and more FIs will come out with that kind of a report, which means what? That more and more flow is going to come to the India, making India as a shining star among the global investors. So these are the hard fact data in front of you, and you can look at it how India will expand its ROE and will be the second largest ROE in terms of absolute value, only below US. Now that's on the PE and the ROE, and I thought now Mohit would be convinced about whether we are valuation is at high or not. Look, let's look at another metrics, and I thought let me just spend more time on this. If you look at the India's, how much India basically contribute. US has been the biggest big daddy of the world, almost accounts for 50% of total market cap in the world. And then we have China, Japan and Hong Kong. India is at this point of time the 5th largest in terms of the market cap contribution. But if you look at the India shares in the global market now, market cap, we are at 3.6%. In other words, India is now becoming a more and more dominant player in the world. And when that becomes, more and more institutional investors, global I'm talking about, want to participate in that growth story, because ultimately everyone paycheck is decided, because they are all ultimately humans who are fund managers, and their paycheck is a function of what kind of alpha you have been able to generate on the portfolio. And the moment India's share keeps increasing, they will have no other choice but to keep increasing. I'll give you a very classical example. I distinctly recollect when Jio got launched, and this data is available in the public domain, you should look at it. Most of the mutual fund were under owning Reliance Industries in the portfolio. And I happened to speak one of the CIO at that point of time, and he said, Sunil, we don't have a choice but to increase our allocation to Reliance. Why? Because Reliance has started doing very well. If we don't take exposure, our portfolio will underperform. If our portfolio will underperform, we have no other choice but the redemption will come into. And that exactly what is happening, going to happen. If just replace Reliance with India, more and more sale coming to the India, it will force many fund managers to take exposure to the Indian equity market, and that will have a very virtuous kind of a cycle for this one. Now, one question that some of our global investors keep asking me time and again, India rupee depreciates. And if that's so, does it really create wealth for the investors in the dollar terms? So what I did, I'd look at MSCI India, MSCI Emerging Market and MSCI World. And I must tell you, based on my last 30 years experience in the equity market, even though India is a part of emerging market, we should never compare India with emerging market, because if you do that, you will always realize that India would be the far much better as compared to any other emerging market in terms of the performance, even in dollar terms I'm talking about. So we should not compare. But if you look at India in dollar terms, this is in dollar terms, so that's why I put a dollar sign here, 8.4% in 10 years versus emerging market 2.1. Can you imagine 4x outperformance over a longer period of time? And so it's like you come in, like since it's a World Cup, so let me take an analogy of a World Cup cricket. It's like India versus Netherlands in the cricket, you know, it's something very similar, India versus emerging markets in that sense. But even if you look at 3 years, 13.9 versus 8.6 of MSCI World, 5 years, 8.6 in dollar terms versus 7.8 of developed, that MSCI World is more dominated by the US, because US almost accounts for 50% of the world market cap, and MSCI Emerging is 0.6. This is in fact MSCI 3 years is negative. Only in 10 years the developed did well as compared to India, but the difference is marginal, 40 bips over a 10-year period of time. And as we keep moving, as ROE keep expanding, I think this will. So the question that some of our NRI customers would have in their mind, where do we park our funds? India versus US. And if you ask me, even in dollar terms, India should outperform significantly to the US market, purely because of the growth, purely because of the momentum, purely because of the reform, purely because of the strong leadership. Of course, if you remember last week, I did mention how Indian Central Bank is keep increasing gold percentage in the forex reserves. And I did some, I went through some data from the World Gold Council, and I've realized more and more central banks are buying gold in last 4 or 5 months. And one of the reasons, I believe that a lot of central banks are keep losing faith in the US market. I personally believe, and this is my personal opinion, that US seems to be going through a major, go through the major financial crisis in the next 3 to 4 years, purely because of the debt, purely because of the poor leadership, and that will encourage more and more assets being diverted to another safe haven, which could be gold and which could help them. So that's what's going to happen. But in dollar terms, India will definitely outperform in dollar. Again, I'm repeat, not only the developed but the emerging markets too. And sometimes we say emerging markets available at 10 PE. Why should we not buy? And I have a simple question. Why should you buy Titan, which is available in excess of 50 PE, and why not some another company like Kalyan Jewellers or TBZ, which is available in a single-digit price to earning, or PC Jewellers? If the P is the only reason why you should allocate, then you don't need MarketsMojo, you don't need Sunil Damane, you don't need any fund manager in the country. Then the P is available in the public domain and you can invest. I think it's much beyond the P for someone to. So don't put an argument that emerging markets P's are lower and hence we should buy there and not buy in India. I think that's not the right way to analyze it. I've come across very interesting, this is more of a behavioral finance thing. Okay, when do we prefer as an investor? When we said, I also included, passive versus active, and somewhere investors are still, they keep changing based on the market conditions. So if market is down, people prefer to, or when the sentiments are a little low, people prefer to invest in a passive funds. The moment market sentiment improves, investors prefer to invest in active funds in the hope that active fund manager will be able to generate alpha over the benchmark. So look at this data. We all know that April, May, the sentiment was just started reviving because Jan was bad, forget Jan, December was bad, Jan was bad, Feb was bad, March was bad, and investors were not convinced that April and May would keep sustaining. So you look at passive got more funds of 6,900 compared to active. Something similar happened in May also, but then market, April shown some strength, May shown, and market investors got convinced, and look at this fund. And the numbers as a percentage just keep on decreasing. So once which was commanding 64% passive started coming down to now in tens. And that's a very, and this is not only for this financial year, you go back the data and you will get something similar kind of trend. And this will happen in the future also. So if you really want to know where investors are going to park funds, it's a function of market sentiment. Again, I repeat, passive will take dominance when the market sentiments are down. Active will take dominance when the market sentiments are good. Simple. Now, there is a positive trend which has happened, and then the negative. Negative is also related to the mutual fund, but I'll come to this one. Market sentiment was down for before April 2020, last 1 year or so, market sentiment has really taken a huge beating. And number of active investors in the country started coming down. This is active investors, not the number of demat accounts open, okay? In June 2022, it was 3.8 crore, which came down to 3.74 crore in September, which further came down to 3.53 crore, which further came down to 3.27, and in June, 3.09. So you can imagine almost 71 lakhs active investors move. And what is the definition of active investors? Those investors who have not even traded once in 12 months. That's the definition of active investors.
They have traded.
Huh?
Those who have traded
They have traded once. That is the definition of active traders. Sorry. And that increased to 3.34 crore in September. Why? Because market is on a constant. So normally there is a tendency of investors, if the market sentiments are down, they'll want to prefer lie low. And the moment sentiments improves, they become active on the market. So this is what has happened. And the negative trend, despite equity flow to the mutual fund, there's a net inflow has come down, and if this trend continues even in FY 2024 also, that trend will be lower than what it was there in FY 2022. In FY 2022, it was 2.68 lakh crore, which came down to 1.8 lakh crore, and for September, that is trailing 12 months, September, it came down to 1.64. So this is 12 months, this is trailing 12 months. If the market and while the SIP is growing somewhere, investors seems to be profit booking in the mutual fund. That's what the data suggests. And so while SIP is flowing, the lump sum, there is an outflow. And due to that, the net, the inflows are not so positive. And if that happens for next 6 months, there will be a second year in a row that mutual fund would have seen less inflow than what it saw, what it has seen in FY 2022. That was the best period, in fact. And when the market sentiment was down because of COVID, 62,700 crore, in fact, there was an outflow from this one. Now, Mohit did mention about in the impact of Israel and Hamas. There are empirical evidence available not only for the Indian equity market, for the global market, that event like geopolitical tension gives a good opportunity to buy, not a good opportunity to sell. Why? Because the sentiment will go down. The good shares are available at a reasonable price and you buy that. On Monday, Indian equity market went down. But post that, what happened? Market has shown a lot of resilience. Now go back and rewind. We had this Russia-Ukraine crisis. What happened? Yes, market did go down. But what happened then? No one talks about Ukraine-Russia crisis. The war is still on. It has become a normal for the world now. 15 days back or 1 month back, we had this issue with Canada, and there was a fear because of geopolitical tension that a lot of Canadian pension fund may withdraw funds from the Indian equity market, pushing down the prices of Indian stocks. Nothing that sort of has happened. In fact, on the contrary, no one even talks about now the Canada-Ukraine geopolitical tension. If I would not have mentioned, it would not have stuck in your mind also, because we had a geopolitical tension also with Canada. So something similar will happen with Israel and Hamas. I don't think it's a concern that could spook Indian market sentiment. So I believe it's not at all a concern for the market. In fact, Indian equity market, as I said, has done well and will continue to do well, irrespective of what happens to the Israel and Hamas episode. And I was reading some article, like I was reading FT today, Financial Times, and they were talking about, this country will join, so on and so forth. I think they are all the probability that we are talking about. I don't think it's going to be a world war, like someone, not FT was saying, but some other people are saying that, there could be a result into a world war. Nothing of that sort going to happen. So don't get fearful. If at all the market goes down, that should be used as an opportunity to put more money rather than taking out money from the market. Remember, the cardinal principle of making money in the equity market is that you should buy low and sell high, and not other way around. And that's the way you should look at it. So for some reason, if the market is giving you an opportunity, please that as a user an opportunity to add more rather than taking money out from the market. Some of the quickly major news happened. India's retail inflation as is, but in the US, it has moved up. Even the core inflation has moved up. Now, one thing which has happened is that the tomato prices have come down drastically. Again, a prediction here. While the tomato prices have come down, onion price will go up in next 1 or 2 months. And that will keep, again the inflation will move up. So most probably the third quarter inflation in India also can see a spike purely because of the food inflation. Food inflation accounts for almost 1/3 in the complete inflation basket. So that could happen, and onion is one vegetable that you should closely watch. Probability is very high that onion prices will go up. It doesn't mean that you should go and store onion at your home, but probability is very high that onion prices can move up. We'll wait and see. We are in the month of October. Most probably that can happen in the month of November or December. Normally, winter, the prices of vegetable normally goes down, but onion could be the exception. That's my senses. This is my personal opinion, not MarketsMojo opinion. Deficit, India's trade deficit is narrowed. That's a good thing. In fact, yesterday we had a very two good news. One is that inflation came down and IIP moved up. So that's a very good data set. I think somewhere there is a mixed signal coming from the IT company. The initial, if you look at HCL came out and think the post result, the script moved up, Infosys moved down. So is the case with TCS, but doesn't looks like a very grim scenario for the IT. It's not that we are going to see a crack in the price of 10% or 15% in the IT companies. FIs have turned negative. They are negative. Our sense is that FIs should turn positive by next week. So if I'm coming in front of you next Friday, most probably FI numbers would be positive, not the negative. And for this week, Sensex and Nifty gained by 0.4 and 0.5 respectively, despite on Monday we saw market cracking because of Israel and Hamas war-like situation. Mohit, did I cover all points or did I miss any of your other question?
No, I think there's one question you missed, which is within this particular increase that we are seeing, I would like to focus on large, mid and small, because, penning down in terms of overall market is fine, but I think investors still look at opportunities where they should be parking their funds, whether it should be higher exposure, whether the rebalancing should happen towards large cap, whether they should maintain a larger mid and small cap exposure. So I think that's one thing that, I know your view on it, but I think it's better if we can express that view.
Yeah, sure. So we strongly believe that as an investor, and if you have a time horizon of 3 to 5 years, you should definitely increase your exposure to mid and small cap. First thing, they are not in the bubble zone. They're still trading below trailing 12 months price to earning. as I speak to you, both mid cap as well as the small cap. And if you need the data, please write to us and we'll be more than happy to share that data to all of you. That's number one. Number two, if you look at historically, Indian market over a longer period of time has always outperformed, the mid and small cap has always outperformed the large cap. And that's where the delta comes in. In fact, I distinctly recollect one of the quote of Rakesh Junjunwala, when one of the journalists asked him that why don't you buy Nifty 50 companies in your portfolio? He said, I buy those companies which could potentially become a Nifty 50 company. In other words, he would pick up those small or mid-cap companies which are not big, but they have a potential to become a big. And once they become big, it adds a lot of delta to your portfolio. And something similar as an investor, you should do that. Historically, if you look at 5 years, 10 years, 15 years, 20 years, you would always say that consistently mid and small cap has outperformed significantly to the large cap. And if you are a long-term investors, it makes a lot of sense to go for increased allocation of mid and small cap. Only thing I would put, caveat I would put it, please do your due diligence when you invest in mid and small cap. Why? Because you need some amount of research, you need some amount of expertise on which mid and small cap you need to get into. Otherwise, those companies can become a dud companies and then you will basically lose out very significantly. So your stock selection within the mid and small cap need more due diligence as compared to the large cap. But once you do that, or once you take an help of an expert, I think it makes a lot of sense to increase your allocation to the mid and small cap. Hope that answers, Mohit.
Yeah, that answers.
So let's open the floor for question answer. Mohit,
Umakantji, Mohit sir, good to see you. Under current volatility, is it prudent to invest in model portfolio mutual funds or in PMS? I wish to make additional investments next week. Umakantji, yes, it is a good time for you to invest in equity markets. As you know, I'm not a big preacher of mutual funds, primarily because I firmly believe that for any investor who's looking at a decent outperformance to the index, mutual fund may not be the right vehicle, primarily because it is too diversified. So my preference would always be towards model portfolio or PMS. Now within these two options, if you have a minimum ticket size of 50 lakhs, then PMS is obviously a much better option because of the sheer execution benefits that you have there. But if not, then I think model portfolio is something that you should be eyeing at. But definitely it is a good time. As Sunil has pointed out, there are very few experts in the market who continue to hold their view. We have, over the last 8 years now, when we have taken a view, we've held that view for a longer period of time. So I remember there was some time back, and you all know the name, so I don't need to take the name. A very famous brokerage house came and said that we've stopped doing any research on mid caps because they can't see justified valuations. And I am very surprised that when you actually look at the valuations and you actually look at where the index is trading over a 10-year average, and when you see the potential of the ROE expansion, you can't clearly see that there is a possibility of a decent return even when Nifty has crossed 20,000. So I think it is sheer investor phobia which is driving the market, where you see that fear of heights. We talk about, and this is something that really amazes me, because certain times we talk about that the market should grow at 14-15%, but bhai market badega kaise agar all-time high ko cross nahi karega? It has to cross the all-time high, then only it will grow. Na? 20,000 has to become 25,000, that has to become 30,000, that has to become a 40,000, and someday a 1 lakh for it to move forward. Then why do we get, why do we have that fear when the market crosses a high? So I think that is an interim short-term fear. Is it a good time? According to me, it is definitely a very good time to get in.
Sushil is asking, Sunil bhai, good evening. I have 2 questions for you. What made you believe that Popper stocks will do well despite they were going down relentlessly? Second question, you have been saying that stock may go up or down based on what the street expects. Where is the data available? Okay, let me answer the first part. So see, if you remember, and we were doing a road shows 3 months back, me and Mohit in some of the southern states for PMS. And at that time we were holding PMS, in Infinity portfolio paper stocks, and they were down and out actually. And a lot of people ask, sometimes people do get fear to ask me directly. So they were asking Mohit, कि भाई paper stocks क्यों? And Mohit in turn was asking me, कि सुनील क्या कर रहे हो? Paper stocks का क्या है? The reason was very simple. We always look at the risk versus reward ratio. Okay, what is the downside risk to that company versus the reward? And if the equation favors the reward, it makes sense. At that point of time, if you remember, if you go back my webinar at that point of time, I did mention that paper stocks, the risk versus reward definitely in the favor of reward. And that's what exactly is played out. If you look at, and I think I made a presentation yesterday or day before yesterday about how much the paper stocks have gone up, and each and every paper stocks have gone up substantially. Of course, we do own, there's a disclaimer that we do own paper stocks in our PMS portfolio. We have not exited any of this. Despite that gloom and doom scenario was there, we have not exited a single paper stock that we are holding in our PMS, and then investors are reaping a benefit of that. So reason why? Because we believe that risk reward was in favor of reward at that point of time. Even as on today I speak to you, we do see that risk reward continues to be in favor of paper stocks. So that's one. In fact, there was an interesting news that I was listening to today, that there is a news, okay, there is a news, so there is no, it's a rumor, okay, let me put it this way, it's a rumor, it's not confirmed news. There is a possibility that China may announce a big stimulus package, and if that happens, it would benefit even the paper stocks. So in that case, that happens, it will further give fillip to this. Second thing, if you look at the valuation of the paper stock, as we speak, even though if they run up, I think some of the paper stocks continues to be trading at a very, very good valuations, and that leaves a lot of scope for a capital appreciation. Many of them are dividend-paying companies. Many of them are enjoying a good ROE, very good management, and yet, even if you look at the market cap to sales, if you look at the price to earning, they are available at a very, despite the run that we have seen in them. So that's why we still believe that despite the run up, risk reward continues to be in favor of reward for the paper companies. The second question that you have been saying, the stock may go up or down based on what the street expects. Where this data is available, sir, stock goes and up is a function of the sentiment. I'll give you one classical example. We own one railway stock in our portfolio, in a PMS portfolio I'm talking about, and that stock was hitting the lower circuit. There was no change in the market, what we call the news in that company. It's just that it's a sentiment, and suddenly the same company now going up upper circuit, and we not exited that company. So sometimes the news is not available, it's a sentiment. Sentiment is not something that the data is available. Sentiment is that what you and me feel about the market. That's a general. So if your mood is bad, like on Monday, when the mood was bad because of Israel and Hamas, the market went down. And the same company next day, there was no change in the fundamental of that company, am I right? It's only the sentiment basically so poor, so people started selling in this. The next day sentiment improved, and same company moved up. I'll give another classical example. There's one company which we are owning under our PMS also is a mid-cap software company. One day the company was down substantially. There was no news. In fact, we search for news also. Is there something which we are missing on that? Because we wanted to take a call on that company. There was no news. And so next day, the script moved up, despite there was no news on that company. So I think that data is not available. There is no something data. It's sentiment. And sentiment, it's more like an air which you can feel it, but you can't measure it. That's the kind of stuff. You can't see it. That's the thing. Mohit Sarji is the right person.
Modak want to know peaceful ways of investing. The only simple peaceful way of investing is to fill it, shut it, forget it, and give yourself time. I'm going to do a research on rolling 5-year kind of data on equity markets, and I think if you have a 3 or 5 year view, the best way of doing that is to make an investment, make a commitment either through model portfolios or either through PMS. Keep following the advice and do not get influenced by what is going on a day-to-day basis in the markets. Because if you look at even a Nifty CAGR over a 10-year period, it has been a 13%. If you look at the CAGR of the mid-cap index over a 10-year period, it has been a 17%. If you look at the CAGR of a small-cap index over a 10-year period, it has been 19%. If you look at the CAGR of micro-cap index over a 10-year period, it is 24%. So what does it tell you? It tells you that patience has always been rewarded in the market. Impatience and trying to act more intelligent in trying to take cash calls, moving out of the market, moving in the market is not the right way. So find a trusted advisor, and money is made out of sitting. Actually speaking, Binoyji, what you're saying, it is a very peaceful way. It is us who complicate the process of investing by making sure that we take random calls. By, I have been an Infinity customer, for example. I know that my portfolio, I have seen a down of around 17% and I have seen a up of around 36%. All of that typically happened in a period of 1 year. Had I reacted at a 16% down, I would have lost miserably. Had I reacted at a 36% up, I would have not been able to continue. So these are purely numbers. The only reality to the fact is that if you have a 3 to 5 year or maybe more than that kind of a focus, then the money will grow. There is no asset class. You take debt, you take real estate, you take gold, you take any asset class in the country today, which has grown on a 10-year basis faster than equity, or which will grow in the next 10-year basis faster than equity. The only thing that is required is, as you rightly said, money is made out of sitting, but get your investments in place. Asset allocation is key, again I keep saying that, but get your investment in a product and then you sit out there and measure it on a 6 monthly basis, measure it on an annual basis. That's all that you need to do.
So if I have to summarize, very simple. If you want to have a peaceful investment, come to Mojo PMS. We will take all the pain and you enjoy the upside of the market. Amit?
Yeah, but I think for investors who may not have that amount of money as well,
yeah,
model portfolio is a great opportunity.
Great opportunity, yes.
And you should remain invested. The only thing that I am telling you is that this 1 week, apne daily jaake that refresh button to see where my portfolio is. Oh, my portfolio is moved up so much, and this is kehta bhi diwana, sunta bhi diwana. It's money on the books. Money is only made when you realize that gain or profit, and for that I think you need to give at least a 5-year period. A calm, peaceful, use as less mind as possible, as less cuteness as possible, to try and take cash calls, to try and become an analyst yourself. I think that is where the big problem of investors are, because everything, it is one of the very funny things that every investor, whether you believe it or not, thinks that they know better than the fund managers and think that they know better than the market. So sometimes the fund managers or the markets then teach them a lesson that this is what happens. But it is a very, very common hypothesis in equity markets, because every investor that I meet, they obviously think that they know more than the market itself. And I don't think so. All combined intelligence of the market, which is reflected in the price, is what comes in. But fundamentally, if you look at anything, any market, see, Sunil has been talking about these 2 stocks that we hold in PMS, which went up, which went down and then came up and all of that stuff. There are constituents that you can't even imagine. There are constituents you can't even imagine on a day-to-day basis. So don't make a hypothesis on it. Because somewhere there is a block deal happening, somewhere somebody is getting out of that particular position, somewhere the promoter is buying, somewhere there is, some kind of a trading that is happening on that counter, somewhere somebody's, you're passing on a deal to somebody. So somewhere there is a liquidity crunch in that, somewhere there is a grapevine of news that is happening, somewhere the technical indicator, somebody has put up a report out there. So there is this whole thing that is happening on a day-to-day basis, and hence day-to-day price doesn't matter. What clearly, when the water settles down, what will come out is how is the company doing fundamentally. whether the company is fundamentally doing good or not, and basis that the increase, the long-term increase or decrease of a price will come. And that's exactly what has been our philosophy, that catch the right company which is fundamentally, do not look at the price unless there is like a major deviation to price that has happened, then we take a course correction. But otherwise, you know that even after we take the beating, we will make sure that we keep holding a stock. When he's talking about a paper stock, when it is coming in my system, it is coming in my system. There's something. When that turnaround happens, then you will realize that, oh my God, this is something that has happened out there, because fundamentally we're doing the right thing. If fundamentally you're doing the right thing, then I don't think so you need to be deterred on a day-to-day basis. Should we have more exposure in debt as compared to stocks considering current market situation? Prateek ji, we have made a case over the last 45 minutes that you should have more exposure to equity. If the house view here is that ROE expansion is bound to happen and the world is talking about it, if the base assumption here is that we are trading at 18.6 versus a last 10-year PE average of 20.1, so PE is below average, ROE expansion is happening. Why are we trading at 18.6? We are saying that we should be trading at 22. For that to happen, you should look at a market appreciation of, purely speaking from the data point of view, around 20 to 25%. In that scenario, post-tax, which debt instrument will give you that? So I personally feel that no, this is not the time for debt. We personally believe that this is a good time in these levels to have a decent exposure on equities. Priyanka, dear Mohit sir, wonderful and reassuring, along with Shri Damania sir, to see you on this webinar. Sir, I want to join your PMS service and again confirm from you that the minimum amount I will invest is 50 lakhs. You're right. We had opened up the window for Mojo professional users to start investing at 50 lakhs. And yes, I'm confirming on this webinar that what I've said and what you've written is absolutely correct. Hi Mohit sir, this is Lakshmi ji. We join MarketsMojo as advisory service now. If we will do any investments on suggestion, can't we treat as our financial advisor before doing our investments? Actually, I want to understand if we retail investors has to do any investment using stock purchase, how can we get help us as your financial advisor? Sir, तो और कौन हूँ मैं तो financial advisor ही हूँ. I am advising you.
No, I think he's talking about the disclaimer of that.
Achha, okay. No, disclaimer. And when I say go and find a trusted financial advisor, if we are your trusted advisor, I'm not saying go and find another one. The disclaimers are obviously meant for the general good of the investors. It is our job to tell you that you have the democratic freedom to look for the advisor that you choose. It is your choice. MarketsMojo is one of the many people who do this particular service. You've been with us, you've seen our performance, and I can only tell you that what we are doing is the right way of investing towards fundamental picks. We don't do, picks basis our emotions. We are not looking at picks basis what's happening in the derivative markets. We are not looking at trading picks. We are looking at fundamental investing, and we have now 8 years behind us, which has proven that fundamental investing, even if you beat it down, is the only way to ride the equity market wave. So, sir, please follow that advice completely, and please trust us, and we will be indebted to you for this trust that you give us.
Rajesh is saying UBS came out with a negative on many Indian banks, including SBI. Does this have an impact on Indian banking sector? See, if you remember, Rajesh ji, our view, as Mohit has been saying, we are more consistent than, we don't keep changing our opinion unless there is a reason to change our opinion. And if you remember, in beginning of 2023, when the whole world was gaga about the banking stocks, we were a little more guarded in our approach. And we did mention that banks should underperform. Having said that, not all banks will underperform. We do own some banks in our PMS also. But we own those banks which have done extremely well. But overall, if you look at Bank Nifty, despite FIs have put in huge amount of money in the financial sector, Bank Nifty has underperformed significantly to the Nifty 50 also and the Sensex also. So, and the reason was very obvious, and we articulate our reason in the beginning on the 1st January 2020, the first webinar when I did about equity outlook. We mentioned that NIM would be under pressure, and today what we stated in January, people are saying now. We did mention that CASA would be a little casualty, and that's what is happening. We did mention that NPA will go up, and even RBI governor is saying that unsecured loans are a little cause of concern. If you happen to listen to his monetary policy latest one also, he did mention that somewhere the risk assessment has to be done more diligently. So that's the reason we said that, again, risk reward. If you remember, that's a simple philosophy that we believe in. What is the risk that and what is there in the price? At that point, everything was there in the price, and if that is there, everything was in the price, where would you get the upside? Am I right? So right now, yes. So we normally don't comment on other people's view, because we may sometimes agree, we may not agree, and sometimes we don't agree. Doesn't mean that we are right and they are wrong. It's just that we have our own opinion. But we stated this in January 2023 that we do believe that banks will underperform. They have underperformed. We did mention that NBFC will underperform. Nifty NBFC did underperform. And we continue to believe that they will underperform going forward. If you look at some of the CASA that has come down for many of the prominent banks, clearly gives that indication. And NIM will be under pressure, whether we like it or not, for the banking. Having said that, we do own some of the smaller size banks, because we do believe this company can outperform significantly. So don't tomorrow come and ask me, then why are you holding some of the banks in your PMS? Because we believe those companies can. See, it's a classical example, and I always keep telling investors, sometimes we are too much focused on something which is not material in terms of wealth creation journey. And the classical example you did mention about SBI. So this is not a recommendation to buy or sell on SBI. Let me put it very upfront here. If you look at the PSU bank did extremely well in 2023. The largest PSU in this country is SBI Bank. And SBI Bank is down from December 2022 level. In other words, in YTD, SBI gave negative returns despite PSU bank is positive. What does this indicate? Your call on the sector may be right, but ultimately you end up choosing the wrong company, then फायदा क्या उसका हुआ? पैसा नहीं बनाना आपका. So my request to all of you, don't take call on the sector, because उसके कुछ फर्क नहीं पड़ने वाला. आप सेक्टर में सही भी चले जाओगे तो फायदा क्या, गलत कंपनी ले लिया तो. So focus on the company, and once you focus on the company, I think that will really help you to create wealth. But our views continue to remain underperformance on the banking stocks. राव सर, आप लोग तो हंसी दिला दिया हमको.
Thank you, Mr. Rao. Serious हो गया था पूरा environment. Mr. Rao is asking, hi sirs, can we buy onions now and sell in December? Sir, मैं भी जा रहा हूँ सुबह सब्जी मंडी. I also tell my wife that we should stock up onions. I mean, I don't know what to answer on this one.
Okay, Brad sir is asking, your paper funds argument is not correct. Anyone who bought paper 1 year ago made no money. So has his money not worked to make wealth? Please comment. So Brad sir, I think, human memory plays a very difficult trick with us. Sometimes we believe that it has not done well, but the reality is that it is done well. And let me give you with example so that, and this data is all available on our website, so you don't have to go anywhere else, Brad sir. And this is not a statement that we are holding those stocks in our PMS or not. West Coast paper in last 1 year is up by 43%. How much? 43%. Sesasai paper 32%. Andhra paper 49%. TN 17%. JK paper almost at the same level. Orient paper 43%, Pakka 141%. Of course, there are some companies which has not done well. like Satya down by 4.1, Imami paper 14.8, and so on and so forth. So I think, yes, there are one or two companies have not done well, but if you look at overall, I think paper companies even for 1 year period have done extremely well. So if you want, we can always share that data to you, sir. And if you still are not satisfied, we'll be more than happy to answer any of your questions.
Where is it that they can, just for to help Mr. Barar, where is it that he can see all the paper companies' performances on MarketsMojo?
Can you, is my screen available, visible? Okay. So I'm just looking at JK paper. Can you just see and then click on compare with peers? And then once you do that, you will have 1 year performance of all the paper companies then.
Yeah, just go to any paper company like JK or West Coast and then go to return analysis section.
And then it's available 1 year, 2 year, 3 year, 5 year, 10 years, and you will get the data. Even if you look at YTD, 3 months, it's all available, sir, in the public domain. Okay, this is for me, I think. Omji Chaudhary saying, hello sir, you have been telling the US economy may be struggling in future. Kindly tell if this global economic scenario, whether Indian stock market will be not adversely affected by the same? Clearly not, sir. In fact, on the contrary, for some reason, if the US economy struggles, I think the fund managers sitting in US will search for the other markets where they can generate alpha. In India being the 5th largest in terms of market cap, India will get attention from those fund managers to generate alpha. And as I told you, 2 years, in US market is below what level they were 2 years back. In fact, Indian market is all-time high. So that correlation between US and Indian market over a longer period is not there. So please don't, and remember this US market is my personal opinion. It's not Mojo PMS or MarketsMojo opinion. And I could go wrong. But the more I read about it, more I understand about it, and I've seen some of the videos, and I think I was surprised, Mohit, that some of the stores, retail stores, so much theft is openly happening in those stores, which really surprised me. And someone said there is no democracy, there is anarchy that's happening in some of this one. And many retailers are closing down the stores in that particular region because they've seen that, and they've mentioned that in the con call. To the investors, it's not feasible to run those. Yeah, Mohit, you were saying something.
No, I was in the US a week back, and also if you read the Economist, the last weekly edition of Economist, they have covered this in detail. So the total loss that retail has got because of theft and because of things been broken into is in the excess of $1.1 trillion.
Wow.
Right. So one of the largest retail chains in the US, which is by the name of Target, for example, has pulled out from some 10-15 cities, primarily because their outlet sale to the kind of thefts that they are witnessing out there has completely gone out of proportion. So people are actually crying to the government. People are making a plea that because there's a lot of spending that they do in security as well of these stores, but there are state level laws, like in California there's a different law of theft. There are some actually some 700-800 rupees exempt, that if you actually can't do a case if the theft is below $700-800.
I think it's $2,000.
$2,000. So there are some exemptions that have been given to stealing, which is resulting in all of this. And this is a big issue which was actually covered as one of the main stories of Economist the week before last. So you're right, absolutely, that retail has its own challenges that they're facing out there. Bala sir, multi-bagger webinar will not be conducted because of PMS. Multi-bagger webinar has got nothing to do with the PMS, sir. It is not that we have launched PMS, so we will slow down equity on MarketsMojo. Actually speaking, we are in the process of launching some 2-3 very large features on MarketsMojo. I'm proud to tell you that the whole production team is back to MarketsMojo, and we are launching some 2-3 very large features. And when we launch those features, I think you will forget multi-bagger webinar, because we are working on some pretty high-end features. The only reason we are holding back to that is, that the features are so large that people may stop looking at MarketsMojo Professional per se, and they will start looking at those features. So we are finding a right time to announce and launch those. Mostly, I think post the Dussehra and before Diwali, we would be launching some very, very large, heavy features in MarketsMojo, which will be a game changer in the industry for every kind of investor. If you're a very aggressive investor, if you're an aggressive investor, if you're a conservative investor, whoever you are, we are going to be addressing that across 4 or 5 new features that we are launching. Nimish has asked, hi sir, please share performance of both the PMSs. Please, your team is lethargic, sorry to say, but it's truth. Please take this feedback in a positive way. I am Mojo Professional customer from the beginning. So point taken. If you want the PMS performance, benchmark performance over the last 2 months, is the time we started. Do we have that, Sunil? Can we?
So now we do this performance to our.
We'll share with you right now.
If you don't mind, can I share my screen? This is sold performance September, and this is since inception 5.1 versus 9.8. This is on 30th September 2023. And very quickly, I'll just take you through the.
So, sorry, if you can just go there again.
Okay.
It was a very quick slide. So we are talking about, as on 30th of September, we are talking about a 2-month performance. Sorry, if you can share it again. What we are talking about is in 2 months on an absolute basis, the sole portfolio has given 9% return versus the benchmark of 5%. These are absolute returns.
These are TWRR returns.
TWRR returns, right, sorry. TWRR returns, which...
yeah, the absolute returns could be higher. Because
absolute can be higher. This is because money has come in different points in time. We have a lot of forms that are still pending. The money is still coming in and all. So the absolute returns can be much higher than this, but it is on a 9% versus a 5%. Please don't stop sharing the screen.
And this is for power.
This is for power. You're talking about a 8.9% versus a 3.44% on the index in 2 months' time, which is a alpha of around 5.45%.
So more than 100% of the benchmark.
So both the products currently on a 2-month basis, as Sunil is rightly pointing out, conservatively, because the absolute returns can be higher than this is TWRR, are outperforming by over 200%.
And please note, past perf is no indicator of future returns.
Yeah, disclaimers all included. Lakshmi ji is saying, Mohit sir, question on onion means retail investors want your advisory services in commodities also. Sir, I will tell you something. I was looking at some of the, success rates of the stocks that we've got, and I keep looking at this. I would suggest that the power in your hands on equity that we've given you is lethal. How much you use, what capacity to use, or you keep, roaming around in the debt and allocation zones. You look at your Mojo stocks today, open that page, look at the performance. I repeatedly tell investors that there is no house today that would broadcast their full success and failure right up on the site. We do that. If you look at Mojo stocks, you'll be surprised to see the whole list and how many stocks are doing well when we have recommended. And obviously, as you know, it tells you the date on which we recommended, the price at which we recommended, whether it is open or closed. And, I can only tell you that the performance of the stocks that we are selecting is exceptionally good, and the result of that is broadcasted on the site. Now, there are certain things that we may not do well, which is commodities, which is derivatives. Those are things that we still have to learn, but I can tell you that if you're looking at equity allocation and if you're interested in making money in the equity markets, then I think you are in absolutely safe hands. If you were to go inside, and transparency is the key out there, so you can see our performance right up through. But good one again. Thank you so much.
Do we have more questions? Yes. Okay. Okay, Sunilji, you are always praised for the present India leadership Modi, but trade deficit is growing year on year in absolute results percent GDP terms. So if economy is weakening, then how market will sustain? Sir, Vikram Singh ji, I'm a little surprised that you are saying Indian economy is weakening. That's not what World Bank is saying. That's not what IMF is saying. That's not ADP, that Asian Development Bank is saying. That's not what the world leaders are saying. I think Indian economy is the only shining star amongst various what we call large economies. In fact, we are the fastest growing economies in the world in large. So in what sense we are saying it's weakening? If you look at even the rupee depreciation against the dollar, I think it's been showing a lot of strength in last couple of years. You look at FDI flow, you look at FI flow, you look at the amount of interest investors, the global investors in India. It's been amazing, the kind of G20 summit that we do and what are the kind of goal that we could achieve. I think there is no way we can say that Indian economy is, in fact, if you remember, Indian economies were among fragile five, if you remember that. We are no longer called in the fragile fund, we are the fifth largest in terms of market cap. And there are reports suggesting that we'll be the third largest economy in next 1 or 2 decades. That doesn't, in what sense we are saying we are weakening? Maybe because of one parameter you look at it and say that we are weakening. I think that's not the fair assessment. That's what I would believe that. But if you need more debates on this, more argument, we'll be more than happy to do that. I know we will have more questions, and since Mohit has come after a very, very long time, people will have more questions to ask. But we are also running out of time. We don't want to hold you back. You please spend your good quality time with your family, have your dinner. We don't want to hold you back because we did receive complaint that आपकी जैसे the wife complains to us कि आपकी जैसे हमारा dinner late हो जाता है. So we don't want to do that. So we'll again come and hopefully Mohit would be there next Friday too with us. So with this, thanks a lot everyone taking time out and attending this webinar. Thanks a lot, Mohit.
Yeah, no, thanks a lot. And I have not come in webinars for around 4-6 months now. So this was my part-time debut. I needed Sunil to support me. I have come as a very underconfident speaker today. I'm sure that this will improve and we will take care of remaining questions. Future Trend again is happening next Friday. We'll keep making sure that we come out with not just interactive sessions, but also try and keep addressing your questions as and when we can keep addressing them. But overall theme is the following. Story is strong. Number 2, we do see upsides. Number 3, invest for long term. There can be possible knee-jerk reactions here and there because world at large, advisors at large feel that we are topping up. We are not picking up at all. As Sunil has made a case, and I strongly believe that that is how the markets is going to go. So have trust, keep listening to us. Whenever you get bad news, start this radio. यहाँ पे अच्छी न्यूज़ ही चलती है, यहाँ पे अच्छे सॉन्ग्स चलते हैं, so you can listen to us. But obviously the other thing that I must tell you is that what is the truth of the market is what we'll tell you, what we see, and the rest is in your hands. So with that note, have a great weekend ahead. Stay safe and spend time with family. Thank you so much.